Hi, I'm Steve. I'm going to share my thoughts on how you can achieve a better financial future. Please remember, I don't know anything about your situation, so think for yourself and use what fits. We spent some time talking about lending money to folks. Now let's move to the other type of investment, buying a share of a business or an asset. An asset could be a rental house, farmland, or anything else that will generate cash flow and increase in value. Buying stock is pretty easy. Brokerage firms allow online trading, and the fees are usually low. Picking a winner, however, is another matter. You're competing with a lot of smart people. When you buy stock, you literally own a part of the company. The future value of the stock will depend on how the business grows sales and profits. It's also subject to investor emotions. All of this is impossible to predict in the short term and very difficult to predict even long term. Finally, all stock prices are set by supply and demand. This happens in the stock market every day. One more important stock-related topic. A group of companies to invest in is called a mutual fund or an ETF. Both can contain hundreds or even thousands of companies, and when you buy one of these, you own a tiny amount of all of those companies. Unless you have a lot of money, this approach is much less risky than picking a few companies yourself. Vanguard and Fidelity are examples of firms who offer mutual funds. For example, both have the S&P 500 fund that has, you guessed it, 500 large U.S. companies. There are no transaction fees, and the annual fee is very low, often less than $10 per year on a $1,000 investment. A different form of the same thing is an ETF, or exchange-traded fund. These trade like a stock. There seems to be an infinite variety of ETFs and mutual funds to pick from. Either route is fine, and both have billions of dollars invested in them. For a new investor, I suggest picking a fund or ETF that includes a lot of stocks to spread your bet across many companies. If you can afford it, put some of your money in a fund that invests in companies outside of the U.S. Relative to stocks, bond prices are more stable, and it's more likely you'll get your money back at the end. Unfortunately, there's a catch. The rate of return is generally much lower for bonds than stocks. It's always all about risk and return. The more volatile the investment is expected to be, the higher expected return investors will demand. No one likes a bumpy ride, but some can be paid extra to tolerate it. Well, that's it for this session. Thanks for watching, and I'll see you next time.